Welcome back to the Daily Crypto Deep Dive. When a single trader opens positions worth close to $850 million across Bitcoin, Ethereum, and Solana, the story isn't the number itself. The story is, who would do this, why now, and what kind of market conditions make a trade like this possible? Because this wasn't a random act, and it wasn't a publicity stunt. This was a deliberate, structured position taken at a very specific moment in the market, and analysts across the space are paying attention for a reason. Let's start by clearing up the first misconception straight away. This trader is almost certainly not a retail investor, and they are almost certainly not a typical hedge fund placing a standard directional bet. The size, structure, and execution of these positions immediately rule out most of the obvious candidates. This looks far more like a high net worth individual, proprietary trading entity, or a specialist crypto trading firm, operating with deep liquidity access and sophisticated risk controls. The key detail is that these positions were placed across multiple assets, using controlled leverage, at a moment when market structure had already shifted. That alone tells us this trader is reacting to conditions, not predicting headlines. Analysts looking at the wallet activity have pointed out that this entity has a history of placing large, concentrated trades at inflection points rather than chasing extended moves. This isn't someone who appears once markets are already euphoric. Instead, their positioning tends to coincide with moments when sentiment flips, but conviction is still uneven. In other words, they move when the market is unsure, not when it feels safe. That behavioral pattern is one of the strongest indicators that this is a professional operator rather than a crowd-following speculator. Now let's talk about what trades were actually placed, because the structure matters more than the headline value. The largest exposure in this portfolio was placed in Ethereum, not Bitcoin. That alone has drawn significant analyst attention. Ethereum represented the majority of the notional value, followed by Bitcoin, with Solana making up a smaller but still meaningful portion. This was not accidental diversification. Analysts have pointed out that Ethereum tends to outperform Bitcoin during early risk-on phases because it offers higher volatility while still retaining deep liquidity. In simple terms, if the trader believed the market was transitioning from defensive to opportunistic, Ethereum would logically be the asset of choice. The leverage used across these positions was notably restrained. Most estimates place it around 5 times leverage on Ethereum and Bitcoin, with higher leverage used selectively on Solana. This tells us two things. First, the trader was not aiming for a fast liquidation-driven pump. Second, they were prioritizing survivability. Analysts consistently note that reckless leverage is usually a sign of emotional or impulsive positioning. Controlled leverage, especially at this scale, indicates confidence in the broader setup rather than the next candle. Another important detail is timing. These positions were opened after several structural conditions aligned. Spot demand had already re-entered the market. Short interest had built up and was vulnerable. Key technical levels had been reclaimed. And perhaps most importantly, the market had already absorbed a wave of selling without collapsing. Analysts often describe this as confirmation through absorption. In other words, the market proved it could handle selling pressure. And once that happens, large players are far more willing to commit size. So what are analysts saying about the intent behind this trade? The dominant interpretation is that this whale is positioning for continuation, not explosion. That's an important distinction. This does not appear to be a bet on a sudden vertical move. Instead, analysts describe it as a bet that downside risk has diminished, that liquidity conditions are improving, and that volatility now favors holding long exposure rather than fading rallies. In professional trading language, this is a regime shift trade. The trader is betting that the environment has changed, not that price will immediately surge. Several analysts have also noted that the distribution across assets suggests an expectation of rotation rather than dominance. Bitcoin often leads initial breakouts, but Ethereum and select high-beta assets tend to outperform once confidence builds. By weighting Ethereum more heavily, the whale appears to be positioning for that second phase, the phase where capital starts to seek higher returns rather than safety. Solana's inclusion reinforces this view, as it is typically treated as a momentum-sensitive asset that benefits from improving sentiment. Now let's address the question everyone asks next. Does this whale know something the market doesn't? The honest answer is probably not in the way people imagine. Analysts are very careful here. There is no evidence this trader has insider information about upcoming announcements or secret policy decisions. What they likely have is better information processing. They see order flow earlier, they see liquidity conditions more clearly, and they understand how positioning changes before it shows up in price. That advantage doesn't come from secrets. It comes from scale, access, and experience. That said, large trades like this can become self-reinforcing. This is where market impact comes in. When a trader opens positions of this size, it changes behavior. Other large players notice. Smaller traders react. Liquidity providers adjust spreads. In effect, the trade becomes part of the market's psychology. Analysts describe this as reflexivity. The trade doesn't just reflect market conditions, it helps shape them. This is why some analysts view the trade as both bullish and risky at the same time. On the upside, it adds confidence and momentum. It signals that at least one major participant believes current prices represent opportunity rather than danger. That can encourage others to step in, reinforcing the trend. On the downside, it concentrates risk. If conditions change and this position begins to unwind, it could amplify volatility in the opposite direction. Another key point analysts are emphasizing is that this trade does not stand alone. It exists alongside increasing institutional participation, improving sentiment indicators, and declining sell pressure. In isolation, a whale trade is just a data point. In context, it becomes a signal. Analysts are careful not to overinterpret it, but most agree it aligns with a broader shift toward risk acceptance rather than risk avoidance. Now let's talk about market impact, because this is where the story extends beyond one trader. In the short term, the presence of a large leveraged long can increase upward pressure, especially if price continues to move favorably. Short sellers become more cautious. Liquidity thins on the sell side. Momentum strategies activate. This can create a feedback loop where price rises not because of new information, but because of positioning dynamics. Analysts have noted that this is often how sustained trends begin. In the medium term, the impact depends on whether the trade remains open. If the whale holds the position through volatility and continues to add or rebalance, it reinforces the idea that the market has entered a new phase. If the position begins to close, analysts will watch closely for signs of distribution. Large exits can mark local tops, not because the market is weak, but because the trade has fulfilled its purpose. Longer term, the most important impact of this trade may be psychological. It reminds the market that large capital is willing to commit again. After long periods of caution, markets are driven as much by confidence as by fundamentals. When confidence returns, behavior changes quickly. It's also worth noting what analysts are not saying. They are not calling this a guaranteed signal. They are not framing it as a prophecy. Most are emphasizing that whale trades fail all the time. They just fail more slowly and less publicly. The difference is that professionals manage failure. They exit when conditions change. They hedge. They reduce exposure. Retail traders often do none of those things. So what should you take away from this today? First, this trade tells us something about current market conditions. It suggests that at least one major participant believes the balance of risk has shifted in favor of holding long exposure. Second, it highlights the importance of structure over prediction. This trader didn't bet on news. They bet on positioning, liquidity, and sentiment. Third, it reinforces the idea that markets move in phases. Bitcoin leads, Ethereum follows, risk spreads outward. Most importantly, this trade should change how people think about the market, not how they act. The value here is insight, not imitation. Understanding why a whale trades is far more useful than copying what they trade. Because in the end, the question isn't, is this whale right? The real question is what kind of market allows a trade like this to exist at all? And right now, the answer seems to be a market that is slowly, quietly, shifting from caution back toward confidence. Drop your thoughts in the comments, and as always, we will see you at the top.